It's the weekend, and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Oh, did you wait till the bitter end to do your taxes, and this is your one reprieve from that? Well, we are delighted you're joining us. It's Jill on Money. And yes, this is the last weekend before your taxes are due. Some incredibly high percentage of Americans wait till the last week or weekend to file. Did you know this, Mark? I think it's like 25%. Those people are digging the sort of the adrenaline junkie part of that, right? All right, let me just do a quick thing on this, because if you're listening, or maybe you just need to know this very quickly. First of all, we've got a post up at jillonmoney.com with your last minute tax resources. That's number one. If you need to file for an extension, remember, Form 4868. You get a 6-month extension that will allow you to be able to have that time so you can actually file those returns. However, there is a caveat to filing that extension. You are supposed to pay what you think you owe to the IRS. And you got to do that by Tuesday, April 17th, this year's deadline. So if you don't pay whatever you think you owe, or 90% of what you think you owe, you're going to get whacked with penalties. So don't do that. Another thing, if you are going on extension, you still have to fund your IRA or your Roth IRA for last year by April 17th. If you're going on extension and you've got a SEP IRA, maybe you're a small business owner. If that's the case, if you got a SEP and you're on extension, you can fund that by October 17th. Okay, so that's one sort of group of people. I need more money. I need more money. I need more time. Give me the time. Form 4868. Just say it with me. 4868, 4868. Okay. Let's say that you've actually done your taxes, but you're freaked out because all of a sudden you find yourself in this weird situation where your tax returns you can file on time, but you don't have the cash to pay. Ruh-roh. 3 choices. Number 1, you can actually get a little 4-month reprieve, 120 days the IRS will usually give you. You file this application where you can get an extra 120 days to file. Okay? That's easy. The other part is a little bit more, and you get to pay. I mean, if you owe a ton of taxes, these things may not work as well. So, I mean, when I say a ton, I mean like if you owe more than $100,000 in taxes. But anyway, so first thing, I need more time to pay. Online payment agreement application. So you can get up to 120 days more to pay your bill. Next choice, IRS installment agreement. You pay a fee, you get on a monthly plan. Third, use a credit or debit card. It is an expensive way to go. You're going to pay fees. Mark's giving you a thumbs down. If you owe money and you can't pay in full by April 17th, you cannot ignore this, okay? Go to jillonmoney.com. We've got last-minute tax prep resources right there, links to everything. Also, if you're really just starting, don't forget you get free filing, prep and filing software if you make less than $66,000. Just go through it, be methodical, get it done, okay? That's it. Those are your last-minute tax resources. Okay, if you've got a financial question, give us a shout. Ask Jill at jillonmoney.com. Let's go to Bill. He is on the line. I asked Mark to play the song Bill, but he's failed. So it's not Bill. It's called something else. The Wedding Bell Blues is what it's called. Woo! I pulled that right out at the last second. I could hear them singing it. Is that maybe it's the Fifth Dimension or something? But
yes,
I think,
it is.
All right, Bill, you and I are showing how old we are. Tell me what I can do for you, sir.
Well, Joe, thanks for taking my call. My question is regarding 401k strategy.
Okay.
And strategy obviously depends on personal circumstances, so let me tell you a little bit. I'll be 67 next month. As of July 1st, I've been retired 2 years. I have, for my income, I have Social Security, a state pension, and my 401k. I can meet all of my living expenses with about 70% of my income, so I don't have to touch my 401k, and that's by design. I wanted to have that.
Mm-hmm.
So I've had my 401k invested in a large cap growth fund, and up until 1st of February, it was doing very well.
In fact, it did the best on January 26th when we hit a peak.
It did in the 18 months between the time I retired and last year. I did 50%.
What?
Yes.
How much money's in that 401k total?
Just over $400,000.
Is it all in one fund, or is it a bunch of different funds?
Right now, it's all in the growth fund.
Oh my God, you are some player, Bill.
Well, it was just pure luck. I don't know why, but it just worked out that way.
Okay.
So then in February we had the big 600, 700-point drop.
Right.
And I panicked and decided I'd get out, so I did. And that night on the news, and I appreciate your being on the news and your insights there, you said if you're in it for the long term, then just hang tight. And I'm in it for the long term because I don't foresee ever having to touch the money.
Okay.
So the question now is, okay, so if I had left it alone, I don't think anybody foresaw a 10% drop and then it coming back up again in such a short amount of time. If I had left it alone, I would have made about 1.6% last quarter. As it was, I lost 2%.
Yeah, big deal.
Yeah, and big deal. And as of close yesterday, it was down 1.5%.
Okay.
So not bad. So my question to you is, for my personal situation, what would you suggest if it was your money? How I invest it?
I love this question. That's number one. I love it.
Well, I was surprised when Mark wanted to put me on the phone.
I love this question, and Mark knows why, because this is just my kind of question. So I'll tell you what. I want to ask a couple of more questions. We're going to do a quick break, and I mean quick. And when we come back, I want to learn a little bit more about what other options you have available to you in your accounts, and then kind of circle back around with what makes sense today, knowing what you learned something really important. That's what I will tell you. Really, really important. And by the way, you're probably still ahead of the game because, I don't know. As we talk today, the S&P 500's up 12% or something from a year ago. So, if you sold that and missed a little bit of that, big deal. Hang on. We're going to come back with Bill. This is the Bill and Jill Show. Bill and Jill on Money. If you'd like to reach us, give us a holler. Ask Jill at JillOnMoney.com. Head over to our website, JillOnMoney.com. You can read, listen, watch all the great content that we create, and you can actually sign up for our free newsletter, JillOnMoney.com. We'll be right back.
Twitter, Instagram, Facebook, YouTube, she's all over the place. Go to JillOnMoney.com to find it all. Now back to the show with Jill Schlesinger.
You're back with Jill on Money. Hey, have you checked out our podcast? You can find it anywhere you find your podcast. But and by the way, I had to teach my mother how to listen to my podcast for the 800th time. Because she wanted to listen to the episode. I had my best friend from high school on my podcast, and he's like an expert on the Federal Reserve. So she wanted to listen to the episode. And so I walk her through it. She calls me back. She goes, that was so easy. Yeah. So I got her to do it. That means you can do it too. It's very easy to do. And if you'd like, you can subscribe to our podcast right on our website at JillOnMoney.com. Okay. We are talking to Bill, who is on the line, who is retired, been almost retired for about 2 years coming up. He's turning 67 next month. His Social Security and his pension cover his needs. He's got $400,000 in a 401k. He got spooked when the market tumbled a bit in February. And so right now, Bill, the $400,000 that was in your old 401k, is that sitting in cash?
No, it's in my 401k.
No, I mean, is it in a money market account inside of the 401k?
It's in the what they call the large cap growth fund.
Wait, it's still there? I thought you sold the large cap growth fund.
Well, I didn't have to sell it. What our state did, or we don't have to move it out when we retire. Mm-hmm. It can stay. It just stays in the fund, in the pension fund that we have.
Right.
So I can just move it back and forth.
Yeah, I know, but what I'm saying to you is you moved it out of the stock market, right? After the market tumbled, did you
Right,
not?
I moved it out of the growth fund.
And where is it now?
Into what they call a retirement fund.
Okay, I got it. All right. So now the big question is, what have you learned from this experience?
Well, I've learned that even a 2,000-point drop shouldn't be scary.
I think that you learned something important about yourself.
Okay.
And I think what you learned was, even though you don't need to touch this money, that you are still somebody who has got to be sensitive to the swings in the market.
Exactly.
Because,
I've watched the market.
Right? And that it doesn't mean that you should never invest in the stock market again. Right. And it doesn't even mean that, like, well, I should just always hang in there no matter what. It means that maybe your tolerance for risk is different today at age 67 than it was when you were 37. Because when you were 37, it was a piece of cake. All you had to do was throw money in there,
right,
let it ride, and every time the market would crap out, what you would say to yourself is, who cares? I got 30 years. I don't need this money.
Right.
Now, ostensibly, you don't need this money anytime soon either, but you do have a certain sensitivity to the to ups and downs. Right. So what I would say to you is this. I would look at my allocation and I might say I may be able to tolerate a little bit less risk going forward. So should I have some bond investments? Sure. Should I have some stock investments? Sure. The question is what percentage in each. So what I would like to ask you is this. Would you be willing to pull back the risk in your 401k, knowing that if the market kept going up, you would not be able to capture all of that upside? Is that okay with you?
Yeah, it's okay.
Okay. And if the market were to tumble, let's just say 30%, how would, how much risk do you feel like you could sort of take? Could you watch that $400,000 go to, 275? How would you feel about that?
Well, that would make me nervous, but again, I don't. It's money that I don't need, but I don't want to lose it either.
Right. So I would say this: if I were looking at your allocation, I might. So I'm so wimpy because you said, "What would you do, Jill?" So you probably have a higher risk tolerance than I do. I'm just going to put it out there. I am really wimpy. I don't like risk. I mean, I know I have to be an investor, but I don't. I would not be 70-30 in this account. I wouldn't be 70 stocks and 30 in bonds and cash.
Uh-huh.
I would probably be more like 60-40 or 65-35. But that's about as high as I would go in your situation.
And we do have a balanced fund that basically is a 60-40 stock bond split.
Yeah, I mean, that may be just sort of like go to sleep at night kind of allocation for you. But again, I want to be 100% clear on this. You ready?
Right.
The minute you do this, you're going to make the change.
Yeah.
The market's going to take off on the upside. You're going to call me up and yell at me. You're going to do. I'm just telling you right now. Well, that's what's going to happen.
I expected you to have a crystal ball and be able to tell me exactly what's going to happen.
Hold on. I got one. Hold on. I'm blowing off the dust. I don't know what's going to happen. Here's what we know about you. We know that you don't need this money. I mean, you'd like to preserve it. You don't need it to live on.
Right.
So we also know that you're 67. You sound pretty healthy. Are you married?
No.
This is just your stuff. And, it would be nice if you had it. Maybe you want to take a nice trip. You want to dip into it later, whatever you want. You don't want it to go to zero.
Right.
So I do think it would be really terrific for you to be able to have this account, go to sleep at night, not freak out on the upside or the downside. So that would be my best advice for you. And, every choice we make as an investor is a choice that is a risk versus reward.
Right.
And you have to really, one of the great things that I learned about myself early on, you have to know yourself, right?
Right.
I learned from myself that, no matter how much money I made on the upside, the emotional high I got from that was not nearly as significant as the pain I felt on the downside. I learned that really early. It was why I was not a great trader. Like I was at my first job on Wall Street, I was a commodities trader. And when I would make a lot of money, I'd be like, oh, that's good. And when I would lose a lot of money, I wouldn't sleep. I'd be anxious. I wouldn't eat, which is amazing for me because I love to eat. And so what I would say is that if you know yourself and you just accept that, then you stop worrying about the swings in the market. So if you really got an iron stomach and you don't care about risk and it does not bother you, that's one thing. And if you do now learn that, hey, you know what? At 67, I have a different risk tolerance than at 37. That's just called being a human being. That you say, okay, I want to make sure that I don't feel that kind of I don't want to feel the anxiety. Why should you? In some respects, there's two ways to approach your current situation.
Okay.
You could be the type of person who says, I don't need this money. I'm keeping it all invested all the time, no matter what. Too bad. That's fine.
Right.
And that would be great if you did not just learn that it kind of bugged you when the market went down. The other approach is, I already did all the hard work, and my Social Security and my pension covers my needs. Why would I take risk with this money?
Right.
What a dumb thing to do. But I've heard from those two types of people exist out there. So I think you're more of the, who needs the risk anymore? I've got plenty of money. That's my sense for you. Can you deal with it?
Yeah, I can deal with it. I'm kind of in between whether I really care or I don't. I read a investment article in the paper a few years ago that really solidified it for me. And the guy, I don't understand this one, but the guy's question was, I have $1.5 million in my 401k, which I felt badly about at that time.
Mm-hmm.
And he says, that will last me 10 years, including my Social Security. And I got, what kind of expenses does this guy have?
Yeah.
And then she answered this question in a general format and said, how you invest it depends on what your needs are.
That's right.
I don't need the money, so I don't care.
I get that, but I will say this. You just, as I think we started this in the beginning, which is you just learned something really instructive about yourself. You're right. You don't need the money to live on. You're living within your means. That's awesome. But you also just learned that a market tumble does impact you. Take that very seriously. Thank you so much for calling, Bill. All right. We have got a huge show ahead of us. Stay tuned. And if you've got a financial question, let us know. Ask Jill at JillOnMoney.com. We'd love to have you on. Go to JillOnMoney.com, by the way, and register for our free newsletter. We'll be right back.
The cure to your financial problems could be just a phone call away. 855-411-JILL is the number to dial. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. If you've got a financial question, we would love to help you out. Our phone number here is 855-411-JILL. I did that fast because Mark doesn't want you to call. He's already done with you. Sorry. Now, we want you to email us because the reality is when you sit down and start actually telling us more about yourself, it helps us answer your questions better. But, of course, if you just are listening and you're riding around and you just say, Siri, dial 855-411-JILL, we can do that too. Have you gone to the website lately? It looks great. much to the chagrin of my former designer, who told me she thought it looked like. No, she didn't say crap, but man, that was a side shot she sent at me. Is this an interim site, or is this where you actually ended up is this where you wanted to go? Dripping with sarcasm, she asked that. I have to look at that again. That would crack me up. It looks like it's just sort of a cookie cutter Squarespace site. I'm like, that is so funny. It is a Squarespace site. Squarespace doesn't even actually sponsor us, but I'm going to say that it is easy. Isn't it not so much easier to use than our previous site, Mark? Night and day, he says. So it doesn't look as pretty according to her, but I think it's very easy and clean, and that's us. We are easy, clean. We don't need a lot of foo-foo. Okay? All right, let's answer a question from Barbara about long-term care insurance. She says, I'm not sure I can afford it. Our net worth, she and her husband, $480,000. They're just on the bubble. They're retired. But this insurance would only be for her. Her husband is not eligible due to health reasons. Barbara says, we live on Social Security checks and a small pension check of my husband's. We are debt-free. We live modestly. I can get a rider through my life insurance policy at about $350 a month. I need a little more information, Barbara. First of all, I want to know your net worth, 480. Does that include your house or it does not include your house? That's number one. I want to know what that rider would give you for the $350 a month. Because, you know, you could totally roll the dice. I mean, it's scary, right? But if the odds are that you will, end up surviving your husband, you could then just say, well, I'll spend my money down, and if I needed care, I'd spend that money, and so be it. That's one way to think about it. But, you really are right on the cusp. Because if that money, that 480 includes a house, if maybe, if he were to become ill, you get to keep the house. If you were to become ill, I know that's unlikely, before him, he would keep the house. I don't know. I need a little bit more information. My gut is telling me that I need to know more about what that $4,200 a year is really going to buy you. Because it could be great. It could be a pretty cheap way to give you some insurance. But as you said, if you're really only living on Social Security and a pension check, and it sounds like you are living modestly right now, maybe you don't need this. I don't know. That's what I need to figure out. So a little bit more information, and we'll be hopefully better able to answer your question. Okay, here is a question from Ellen about her 401k, who is 76 and still working. All right. Boom, boom. Love her. All right. Ellen's 401k, she writes, has dropped by about $25,000 since the end of January. I'm starting to panic. My contributions are, well, I know why you're panicking. Oh, for God's sakes. Come on, Ellen. She's 100% stocks, 27% international, 73% large U.S. equity. Should I move things around a bit or hang tight? Yeah, just go ahead and rebalance right now, hon. Let's get that done. I know that people are going insane because when markets are volatile and fluctuate, now's the time you start. Why didn't you call me on January 26th, right after the stock market reached a new high? That would have been a perfect time to call me because it's going to go on forever, says Mark. So, Ellen, yes, you should reallocate. I would need to know more about you. So what I would want to know is, number one, is this the only money you have? Number two, if it's not the only money you have, how much money do you have total? Number three, what happens when you actually retire? Will you be entitled to a pension? I know you'll get Social Security. Number four, what are my other options in this account? We need to know a little more information. But my inclination is that if you are 76 and you're starting to panic because you're 100% in stocks, you should be panicking. Nobody needs to be 100% in stocks. I don't care if you're 25 or 75. Ideally, I would say that you're probably going to be a balanced investor, so you'd be 50-50. So great. And I'm not the type of person who waits around to make those kinds of changes. It's just me. I myself like to sort of pull the trigger and not wait around for that. So those are my thoughts. Thank you very much for writing. And by the way, for all of you out there who just tend to want to make your allocation decisions only when the market goes way up or way down, calm down. Calm down. This is not as hard as you make it. I know we are human beings. This is a very terrible fact that we grapple with all the time. You really have to know that part of the problem of being a human being is that you've got emotions. That's that panic feeling, right? Essentially, there's really only two emotions in the world of investing. There is fear and there is greed. Fear takes hold when the market goes down. Greed takes hold on the way up. That's why it's hard for you to sell when the markets are reaching new highs. That's why you are panicking and feeling like you should sell when the markets drop down or move around. Resist the urges. We are animals, but we do not have to succumb to our animal spirits. Okay? You're listening to Jill on Money. Wasn't that poetic? 855-411-JILL. Send us an email. AskJill@JillOnMoney.com. We'll be right back.
The cure to your financial problems could be just a phone call away. 855-411-JILL is the number to dial. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. If you've got a financial question or concern or a comment, feel free to send it along. Ask Jill@JillOnMoney is our email address. And hop on to the website, JillOnMoney.com. Subscribe to our newsletter, our free newsletter. Some of you asked whether we charge for it. But Mark, maybe we should charge for it. I know. We're not charging for it. Sorry, man. We're not building that revenue stream. Listen, we'll get you hooked on it first, then we'll charge you for it. Isn't that how it's done? You know, do you like your Netflix for $7.99? How about $9.99? How about $12.99? All of a sudden, you're paying real money for this, right? I don't know. Netflix is worth it to me. I never go to the movies anymore, though. I feel kind of bad about that. I don't know. At what point? I don't know. Anyway, a few weeks ago, I wrote a column about cleaning up after tax season. And here's a note from Jack, who is a CPA and a CFP. This is my kind of guy. He says, I'm a longtime follower, and as a CPA and a CFP, I respectfully submit a comment relative to the retention of brokerage statements. Jack says he keeps his for, quote, an extensive period of time, and here's why. He says, there has been substantial misconduct by major corporations, particularly over the last 10 to 15 years, generating legal actions. Retrieval of information, sometimes going back several years, allowing individual investors to recover losses is much easier if the statements have been retained. Vanguard allows me to retrieve only the last 2 years. Most are retained by Vanguard, but may be more difficult to obtain. In other words, there's no assurance that the required information will be included. So that's a good point. I mean, you just don't know how long things are going to be needed. Of course, if you need something for tax purposes, cost basis, that kind of thing, then, yeah, you're going to have to maybe keep an eye on it. And according to Jack, maybe longer than you had initially thought. I'm so sorry about that. Your file cabinet's bulging. Jack, wonderful. Thank you. Thank you for writing. It's a great point. All right. Let's see. This is a retirement planning question. I've listened to your morning show with Dave Ross segments on Cairo Radio in Seattle. I'm happy to know you have your own show. Thanks, man. I have $200,000 in a traditional IRA. My income is too high for a Roth. I have $550,000 in a company-sponsored 401k, $100,000 in emergency reserve, $550 equity in my home. I save approximately $8,000 a month. Holy smokes! I have a few expensive hobbies. Well, here's why he doesn't. Mark says he should have more. He's got some expensive hobbies, all right. Airplane and rebuilding collector cars. But still, he earns he earns $265,000 a year and he saves $8,000 a month. That's a good number. Anyway, he's 54. He's single, no kids, forced retirement age of 65. So he says, I'm invested in aggressive mutual funds and dividend-paying stocks. Am I missing something from my retirement planning? What should I be doing to prepare for the forced impending retirement in 11 years? Well, I mean, I think that you're doing well. You're saving a ton of money, which is great. I guess a couple of things to think about. Number one is that when you do retire, it could be worth your while perhaps to convert your traditional IRA into a Roth IRA, when your tax bracket drops down. I don't know if you're going to be entitled to a pension or not, but you didn't mention it. That's number one. Number two, I'm not sure why be so aggressive. Because have you run your retirement numbers yet? Have you actually done that? There's so many retirement calculators out there. I think I would suggest that you actually look at some retirement calculators because it may be that there's no reason why you need to take as much risk as you are taking, and maybe add a few bond funds in there might help. I'm not sure why. So I don't know. I think that with 11 years to go, running the actual numbers would be really important. And I would definitely suggest you do that. And I also would think that, scaling the risk back as you approach the time when you're going to need that money is really a smart idea. So that's it. That's what I got for you. Make sure that those funds that you're investing in are low cost, index funds. Maybe add a little bit on the bond side. Don't have to be quite as aggressive. Sometimes I find that people are more aggressive than they need to be. So let's try to pull that back a bit, and I think you're on track. Good job, and thanks for writing. So if you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. Check out the website, jillonmoney.com, if you would like to see what we're doing, what we're writing, how I spend most of my real time in my real job with CBS, some TV segments. And while you're there, you can sign up for our free newsletter. Mark and I look at what's going on during the week. We kind of see what we've done, what other folks are doing, and put together a nice list of kind of in case you missed it. How long do you think it takes the average person to get through the newsletter? 5 to 10 minutes, depending if you watch all the videos and listen to everything. All right, that's this segment. When we return, more of your questions. Ask Jill at jillonmoney.com. We'll be right back. You're back with Jill on Money, and if you've got a financial question, we would love to hear from you. Our email address is askjill@jillonmoney.com. And this is a kind of question that I just delight in receiving from John, who has a question about his investments. I have 1 year until retirement, he writes, and I would like to reduce the monthly cost of management fees, about 0.5% per month for managed accounts. What does he mean 0.5% per month? He doesn't mean that. He means I think it sounds like 0.5% for the year. He's charged on a monthly basis. I mean, well, first of all, I don't know how much money he has, but let's just say he's paying 0.5% for management, $11,000 a year. Okay. I have a fair understanding of markets, indexes, wondering how to find a CFP that is fee-based and could review my positions on a yearly or semi-annual basis. What are your thoughts? Yeah, okay, I have thoughts. Go to napfa.org, N-A-P-F-A, napfa.org. Those are fee-only planners. Plug in your zip code, and you will find people who will do just that. And you'll pay a flat fee. I mean, you can also go to letsmakeaplan.org, which is a CFP website, and see if you can find someone in your area who will do that. But the reality is, if you don't want to have somebody who is actively managing your money, which you probably, if you've got a good understanding and you're just going to use index funds, it's fine. And you might have to pay somebody, let's say that instead of paying $11,000 a year, you reduce that to $2,000 a year just by only having index funds and managing it yourself. And then you paid another $1,000 every year to somebody who would look at your investments. That seems like a pretty good deal. 11 to 3,000 seems good to me. What do you think, Mark? You in? I think that's all right. So go check that out. Check out those two websites, interview some people, and be upfront. I'm going to manage my own money. I just want another set of eyes on this. All right? Excellent question. All right. Thank you. And thanks for listening to hour number 1. Coming up, hour number 2, an interview, questions, everything. It's all here at Jill on Money. And if you have a financial question, we'd love to hear from you. Ask Jill at JillOnMoney.com. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2, and we are delighted that you are with us today. We have great guests, fantastic guests. There's nothing I like more than a well-crafted documentary that feels like you are watching a work of fiction. Jed Rothstein and Dan David, the guys behind a new documentary film called The China Hustle, they are our guests today. Here's the deal. These guys basically came up with this idea around finding out what was going on with Chinese stocks that were available to U.S. investors. And Jed Rothstein, who is the mastermind behind this, tells an amazing story and rings the alarm on the need for transparency in this deregulated financial world. So up next, Jed Rothstein and long-term short trader Dan David here on the Jill on Money Show. Where did the idea for this film begin? Jed, did you hear about this guy named Dan? Did someone come to you with this concept that something weird is going on with people who are investing in Chinese companies?
Yeah, one of the producers knew John Carnes, who's also in the film, another short seller and investor. She, through John, met Dan and brought the film to Jigsaw, which is where I've done a lot of work, in hopes that Alex Gibney would take it on, because he's the sort of master of financial films.
He did the Enron movie, The Smartest Guys in the Room. He also did that crazy Scientology movie.
Exactly.
Oof.
And Alex really loved the story, but he couldn't direct it because he was already committed to some other stuff, but wanted to executive produce it and said, let's see if we can connect Sarah, who was the producer, and Dan with one of the other directors in our shop, which turned out to be me. And then the idea for the film and the genesis of the storytelling really began just as I describe it in the movie itself, which is Dan and I met in a TGIF in Penn Station.
Mm-hmm. That's so romantic.
It's so...
Your first date at TGIF. That's really a bad story beginning.
Penn Station, I've been going in and out of it for over 20 years, and it just never gets never gets better.
No. Obviously, we're giving up the ability for TGI Fridays to ever sponsor us right now by throwing them under the bus.
It was wonderful.
You know what? I salute everyone who toils there. They're trying to make it work in Penn Station. It's a tough spot.
It really is.
It's a tough spot.
So, okay. So, Dan, you are a hedge fund manager.
I am.
And talk a little bit about how you got involved with investing in China in the first place.
Well, so we were investors in the classic sense of the term of value investors, and had done well in the mid-2000s, running up to 2008. 2008, as you may have heard, was a tough year.
Yeah, it's weird. It does strike me as one of those, why does that sound familiar?
Yeah, it was a good couple years running into that, and we were flat running into September of 2008. And by
flat meaning what? Like you had no positions on?
No, we were even for the year.
For the year.
We were,
okay.
We were up 50% the year before and 50% the year before that, and doing well. 2008, it was just really choppy going into September, but we managed to stay flat as far as not up or down. But by November, we were down 79%.
7.9.
7.9.
Wow.
Yeah.
So you had a hedge fund, and was it filled with a whole bunch of institutional people, or were they just rich people who had extra money who bet on you?
Well, at that time, it was my partner's hedge fund, and he's a really unsung hero in this story, Maj Sweden. There was two of us, and there's a whole team behind what I did. I could arguably say I'm the least important part of that team. For one reason or another, I end up in the movie. And it was his fund at the time. And I ran the venture capital part of our business as well as some of the real estate interests. So it was a soul-crushing experience for him. And, you know, he came to stay with me for a couple of weeks. And I said, okay, tell me about your side of the business now, because I'm now going to have a part in everything we do, including your side of the business. And he explained to me about value investing. And I basically said, look, we shouldn't change anything about what we do because it worked for you for 20 years. And let's stick with this model. Let's consider these last 2 months an anomaly in the market, and it was, and go back to value. And when we looked at value in 2009, almost everything was in China, a China-based company listed on our U.S. exchanges. So we thought, like anybody else, if it's listed on our exchange, they're, you know, regulated by the SEC. The exchanges do their diligence. The investment banks do their diligence. They have a Big Four auditor. We had no reason to suspect anything. And we invested almost everything into these China-based companies long and picked up 229% in 2009.
Whoa. Okay. And so how did you get information? Because notably, the Chinese market itself is sort of opaque. The fact that it had a U.S. listing, you presume that, you know, it sort of has compliance hurdles, that it's been reached. But if I wanted to buy a Chinese company, I am precluded from doing that. I can't go invest in a Chinese-based company from the Chinese market because they have the A and the B, and it's really hard to invest overseas. So your idea was, if it's here, it's kind of cleared this regulatory hurdle, and at least we know that it's kind of maybe not be the best investment, but at least it's not you know, some fly-by-night crazy, you know, Joe's investing.
We felt it was the best investment, and we did the same due diligence at that time that we would do on any U.S. listed company based in the United States. So we interviewed CEOs, CFOs. We talked to competitors. We channel checked and things of this nature. The difference being, to clear these regulatory hurdles here in the United States, it's really about filling out paperwork. And it's really about, you know, having your legal team and your auditors who are just checking paperwork. They're not actually developing the audit. You turn in the numbers and they look at them.
And remember that just in speaking to, like we just mentioned, Enron very briefly, Jed, that like you would imagine that if you are telling this story and you say, hey, look, it's a listed company.
Right.
Was it surprising to you to learn how, in fact, these companies became listed in the United States?
Honestly, when I began this, I didn't really understand the concept that dozens or hundreds eventually of Chinese companies could be listed on U.S. exchanges. And so it was really eye-opening to see the mechanics of that, which are quite complicated. It was also interesting to to see how we're really living in a 21st century economy where capital can flow across borders instantly. But what I found in making the film is that the regulatory framework and the rules of the game of capitalism that are supposed to keep it fair and transparent are kind of stuck in the 20th century. And to me, that's a sort of big takeaway from this whole story. It's less about the specifics of what happened in this set of frauds and problematic companies and more about what kind of system do we want to have. If we want to have a global market, which I think is probably good and probably inevitable, we should really think about policing it in a way so that we can be reasonably sure that what we're looking at is what it claims to be.
We will be back with the guests from the China Hustle, Dan David and Jed Rothstein. During the break, here's what you can do. You can just go to thechinahustlefilm.com and click on the link. You can figure out how to watch it at home. All right, we'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money, and we are talking to two of the people behind the new documentary film, The China Hustle. You know, if you're just joining us, you're going to have to listen to the first segment, but just to remind you that this movie actually begins in the 2008 financial crisis, where I don't think many people were really worried about like the fraud that was going on in Chinese stocks as much as they were worried about the frauds being perpetrated here in the United States from our own financial service companies. But, you know, it is an interesting thing because if you wanted to invest in China, there were a lot of hoops that you had to go through. And then people in the United States realized that there had to be an easier way to make investing in Chinese stocks or Chinese companies accessible to U.S. investors. To understand that, you have to kind of get this idea in your head that, you know, look, China is the second largest economy in the world, but it is still pretty significant totalitarian push behind this weird capitalist structure that is in place. And as a result, what is really kind of interesting is how American entrepreneurs, some of them shady, some of them not so shady, tried to figure out how to bring Chinese companies to U.S. investors. So here's more of our interview with Dan David and Jed Rothstein. The interesting thing, Dan, is that when we look at how those companies were able to kind of use their own sidestep regulators in general, was the premise was, let's find some shell company in the U.S. This company had already been a public company,
right,
but it really didn't have any assets anymore. And did they do a reverse merger? Is that how they did it?
In many cases. Some of them were IPOs. But in many cases, it costs a lot less to reverse merge into a company. And in all fairness, Berkshire Hathaway is a reverse merger. I mean, so it can go fine. But in these cases, you spend anywhere from $100,000 to $300,000 on what they would call a clean shell, which means it has no litigation attached to that old former company. And you reverse merge your company into it. And you don't have as many of the audit hurdles or regulatory hurdles that you would have in an IPO.
And as a result, when you as an investment advisor or a chief investment officer of a hedge fund or a private equity firm, you're looking at it, you say, here's the filings, here's the numbers. Right. You don't know whether or not these are complete baloney or not.
Right.
I mean, because they've been filed.
Right.
You, I presume, started from the premise like these are the numbers.
Well, I start from the premise that you take these numbers at face value, especially when they're not guidance or outlook. These are actual empirical numbers of what they say they did in the past, and you work backwards into if they're lying, there are repercussions. People from Enron and WorldCom, Tyco, they went to jail. That doesn't happen so much anymore, but that's a whole nother segment. And then you find out that it's not illegal in China to steal from an American citizen.
No, I think that's a point of pride.
I could point to a case where Ming Zhao from Puda Coal stole $450 million from U.S. investors. We exposed that, and a year later he was appointed to provincial Congress.
Oh my God!
So you're not elected to Congress there, right? You're appointed. So they'll literally pin a medal on you for stealing $500 million for U.S. investors.
So let's go back. You go 2009. You make 200. So you didn't go out of business in 2008. So that was good.
Yeah.
2009. You make 229%. And then what's the next part of this? I mean, you're killing it.
Well, there were critics like Carson Block from Muddy Waters and Alfred Little, who's John Carnes, that were saying a lot of companies that we had invested in, and maybe we had gotten out of these companies because they had a price target, not because we thought they were fraudulent, but because we bought it at 9 and sold at 28 or whatever it was. They were saying they were frauds. And my partner Maj and I got together and we said, look, we were either good at what we do or we were lucky, and we need to figure that out or we're going to be out of business. So we hired our own China team to prove the short sellers wrong, and we gave them 30 companies to go look at. And they came back and they said the short sellers are wrong. They're understating the problem.
Oh my God. I love the part in the movie where there's a guy who goes up and sort of knocks on the door of the Chinese company and says, hey, I want to give everyone free tea. That'd be so nice. Can I just bring you some free tea? And you guys had thought, how many employees did they just say they had at that point?
They said they had, say maybe
hundreds.
Well, look, they had one truck driver with
and 40 people, I believe he said.
Yeah,
we have 40 people here.
Something like 10x of what it was, and there are all kinds of stories that we have to go through. The tea salesman was a good idea at getting an employee count, and the bravery of some of these China investigators. I mean, they're risking jail time. They've been beaten up. They've been run off the road. They've been pistol whipped, things of this nature.
So you come to find out that these Chinese companies, some of which had done IPOs in the U.S., some of which had done reverse mergers and are now listed on U.S. exchanges, that they're basically fraudulent endeavors, that they're kind of saying, hey, it's as if it's like the Jill Trading Co. from China, from Shanghai, is setting up, and I do a reverse merger, and I then what? How do I get people to invest in this fraudulent? Because there's a part of this that's like you got to have a pimp. So who's the pimp in the story?
Well, number one, the pimp finds the product. So a Chinese chicken farmer doesn't wake up one day and understand how to defraud the U.S. capital markets.
Good point.
So people from the United States go there to any kind of B-level operator and say, what could you do with $50 million? And this B-level operator will say, well, my business would be this big. And imagine I'm holding my hands way out. And the pimp, as you call them, says to them, look, all you have to do is tell everybody your company's already that big. We'll give you the money, and then you can build it out. Nobody's going to get hurt. And by the way, if you get caught, you did nothing illegal in China, so you can't be prosecuted.
And if you get caught in the U.S., then what happens? In other words, if you lie to the SEC, what happens if you're a Chinese person?
Nothing.
Nothing.
I mean,
Because
they don't have the ability to enforce subpoenas. If you come here, they can.
No, they'll put you on a plane and send you home. Now, here, you go straight to jail. Do not pass go, and you've got to post bail or something of that sort. But no. And the ironic thing is when we catch U.S. people stealing from China investors, like the EB-5 program, which is a pathway to citizenship for Chinese, they've caught, $500 million worth of theft of Chinese citizens. Our government has done the right thing and taken that money back and made the Chinese citizens whole, which I take exception with. I think we should put that money in escrow and say to the government of China, here's what we've taken back from our criminals, and we'll make your citizens whole. You do the same.
They get the companies, they list, they get them out to public, and then it's sort of like, it's a little bit like a boiler room almost, that like they've got to set up a shop where they can now distribute these ideas and get people to invest in them. So what is the distribution mechanism for these Chinese companies that are pretending to already have the $50 billion?
There were a cadre, a cartel, call it, of deal makers, law firms, auditors, and really what it became is for the savvy investor, or say somebody who took the short side of the sale, you just say, okay, so they have this auditor. Now let's look into, which is somebody we know that has bad companies in the past. Let's look at the bank they use. Okay, that's 2 strikes. Let's look at the law firm they use. Okay, that's 3 strikes. And then you develop a profile based upon that. And you pretty much know that when they use 3 or 4 of these kinds of firms, that there's probably some there, and you could spend some money looking into them.
We will get back to our interview with Dan David and Jed Rothstein, the masterminds behind the China Hustle, new documentary film. If you've got any financial questions, we'd love to hear from you. Our email address is askjill@jillonmoney.com, and follow us on Twitter @JillOnMoney. We'll be right back. You're back with Jill on Money. If you've got a financial question, give us a call, 855-411-JILL. Send us an email, askjill@jillonmoney.com. We are in the middle of a great interview with the guys behind a really cool film called The China Hustle. Jed Rothstein is the director. Dan David is the main character. And in the press materials, they have a funny thing in it. They say there are no good guys in this story. But there are a few people who are sick of a financial system built on lies. And I think that's where Dan David comes in. He discovers this fraud, and now he wants to know what to do with it. Here's more of our interview. So you start from the long side in 2009.
Yeah.
You make a bunch of money. You hire these people say, oh, my God, Dan's, these guys are investing. And you go hire these guys. You find out that, in fact, it is fraudulent, and then you start beginning the process of saying, let's now bet against them?
No.
What happens then?
I said, well, we don't want to be short sellers. That's not our outlook. We're value investors. Let's not try and learn a new game. Let's go to the investment banks. Let's go to the SEC. Let's go to the exchanges. Let's tell them what we found, and let's see if maybe they could hire us or somebody like us to do proper diligence so that American investors won't be ripped off. And we can just buy good Chinese companies, because we still wanted to do that. And we were just, solemnly pushed aside, threatened to be sued by almost any of these entities. When we're speaking to the exchanges, I mean, it's like, who the hell are you?
Also, were you treated like, oh, you're not some big white shoe Wall Street dude? You're a guy from Pennsylvania doing
We're bullied.
What?
Yeah, we were bullied. And we didn't take too well to that. So we published our first 2 short reports without taking a position.
Interesting.
We said, look, we'll spend $50,000 buying grave plots in China, proving that this company didn't own the cemetery they said they owned. And then there was a pharmaceutical company as well. And we said, well, we won't take a short position, and the investor community will buy our research. They'll love us. So we put that report out, and the investor community said, you're short sellers. We don't care if you say you took a position or you didn't. If you're a critic, you're a short seller.
Okay, can I just stop for a second? Jed.
Yes.
Who devised the storytelling of how to present what short selling is in the movie?
I did.
It is brilliant.
Thank you.
I want that clip, and I want it to go viral. It is the best explanation ever of short selling that I've ever seen. I've been doing this for 30-something years. It's brilliant.
It's hard to wrap your head around, isn't it? It took me a while to really myself understand the mechanism, the key mechanism of the borrowing something and then selling it right away. And I think that's not a natural transaction. So it really took me a while to understand it and to be able to explain it in a simple enough way.
And so right in the middle of the movie, there's this great animation, which is the best explanation ever of short selling, which should be its own animation, and you should basically license it to every investment firm.
I'll tell the animator.
And I think that the concept of betting against is always this It's a strange feeling because you hear from the investment community, oh, those guys, they're the bad guys, they're short sellers. So you also have Jim Chanos in the movie, who's a legendary short seller. And I thought he also did a good explanation of like, look, this is part of the market. You want both sides represented, right?
Right. One of our screenings early on, somebody in the audience stood up and said, you shouldn't have short sellers. They shouldn't be allowed in the markets. They just want to bring things down. And my thinking was, well, if you have a market, you have to have the ability to suggest that stocks should go up and also that they should go down. It's not to say that every short position is justified. Of course, they're not always. But
they don't always work out.
Yeah.
And there's a huge risk in being a short
yeah.
seller,
Yeah.
right? I mean, so that's the other part of it.
It's a huge risk to short a fraud.
Of course.
When you're short, you're only going to make money if the market agrees with your thesis at the same time you do. If they agree a year later, you could be out of business. And that happens all the time. They're like, oh, what that guy said last year, it turned out he was right. He's broke.
Right.
Because he had to hold on to that short. Well, it went up, 10x. But that's what ends up happening. And when you're shorting a fraud, everybody says, well, this company's a complete fraud. You're going to take them to zero. It's easy. A fraud can say anything.
Okay, so you write the research report. You figure you're going to be this great resource to the community.
Right.
You're going to be like the Sandy Bernsteins of the short China world.
Yeah.
You're going to do all this stuff. What happened?
Well, we just said from then on, look, we're just going to embrace it and we're going to short. And one of our first big shorts was Sube, which claimed to have 500 employees and they had like 25. And we filmed that.
So that's a rounding error.
It is. And then Putakol, which I explained Ming Zhao stole the money. And that was a huge shock to the market. And from then on, like nobody took myself or Maz seriously until we started crashing billion-dollar companies.
And what years were
And then the
this was
SEC
happening?
wanted to talk to us.
Well, so let's talk about this. So what years, so we now know kind of the progression. What years did you start actively shorting and making money?
2011.
Just in 11 or 11, 12-ish? When did they?
From 11 on.
11 on.
I'm almost exclusively short now.
Okay, and so why did they want to come talk to you when you started making money and crashing companies?
Well, because it turned out that we knew what we were doing. And look, you have to I have to understand that the SEC takes a great amount of calls every day from anywhere from somebody that's intelligent, like, an investor, to a crackpot. And they don't know who they're talking to. And then, when you make a name for yourself, it's still a one-sided conversation. Don't get me wrong. It's not like you go into the SEC and they tell you what they're thinking and you tell them what you're thinking. You tell them what you're thinking, period. And people have often said to me, you meet with the SEC and you give them this time-lapse surveillance and this lock-solid fraud. That must be a great day for them. You've done all their work. So that's a good day for them. A great day for the SEC is when I do all of that and I've made a mistake too, and they get 2 cases for 1.
Right, because while you're here, I might as well look into who you are.
Right. And I've never met with them represented by an attorney.
Just you alone and your partner?
That's right.
Wow.
Because, and believe me, my attorney's not too happy about it. But I said, I'm not paying you $1,000 an hour to tell the truth. If they have a question, I'm going to answer it. I don't need you there for that. So if you run your business like you're going to be audited tomorrow or you're going to have to speak to the SEC tomorrow, you don't have to rack up all these legal fees. I spend hundreds of thousands of dollars a year as it is on legal fees fighting, frivolous lawsuits.
We'll get back to our interview with the China Hustle guys, Jed Rothstein and Dan David. You are listening to Jill on Money. Hey, during the break, why don't you hop on to JillOnMoney.com? Lots of resources, and you can subscribe to our free newsletter, JillOnMoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You are back with the program that takes the mystery out of your financial life. Hopefully. If you've got a financial question, why don't you send us an email? Ask Jill at JillOnMoney.com. Sometimes when we invest, and we are looking for great opportunities, you hear lots of people like me who will say, oh, you got to invest in the international markets. That's where a lot of the growth is. But of course, there's tons of risk. I mean, you could say like, hey, I'm going to invest in Russia. And then you get new sanctions and the Russian stock market falls. Or you can say, I'm going to invest in Brazil, which, 5-10 years ago looked like about the best investment you could make in South America. It was seen as just this miracle, huge producer of lots of commodities, but completely corrupt, crazy government. And if you want to invest in China because you believe that the world's second largest economy holds great promise, it does. But you better be watching out. That is what is the message, I think, from our guests, Jed Rothstein, the director of The China Hustle, which is a new documentary film available out there to purchase and watch in the privacy of your own home or go see it in a theater. And the main character, Dan David. And if you're wondering, is this an old story, a new story? It starts in 2008, but maybe things haven't gotten that much better in the decade since. That's the real question. Dan, what's the current risk that is now surrounding these Chinese companies that people are investing in from the U.S.?
$1 trillion.
That sounds like a lot. That sounds like another financial crisis.
Oh, there's $1 trillion worth of market cap on our U.S. exchanges. Not to mention how many pension funds that are invested in, say, a Morgan Stanley or something of that ilk that has a Hong Kong, an Asia fund. And the Hong Kong market is a very manipulated market. It's not like the China A-share market, which is ridiculous objectively, but there's $1 trillion risk. And systematically, you have to hand it to the Chinese for planning. They really do. They put out a 5-year plan, but they have a 20-year plan that they don't put out. And they're very good about updating it and sticking to it. And what they saw in 2008 was, wow, thank goodness we weren't so attached to the U.S. market here in 2008. That could have really taken us down with them. And since 2008, they've said, you know what, our term is coming. So they've attached themselves to every market in the world over the last 10 years in a very, very big way. If you go back and just look at the last 10 years, the outflow of China capital buying American companies, buying European companies, and investing into other markets will force the rest of the world to pull China out of any bubble.
All right, and it's 10 years later, and explain what could happen. Give me the doomsday scenario of how we have, financial crisis version 2.0. What happens?
Well, I mean, China doesn't just have a bubble; they have bubbles. They have a real estate bubble.
Debt.
Exactly. They have a debt bubble. They have, where their debt is concerned, they have credit risks for money lending that is done not through banks, and it's kind of dark money lending. There are a lot of different kind of bubbles that China could go through, and any one of those could cause them all to pop.
And if you have a bubble pop in China previously, years and I guess probably 10 years ago, they had a bunch of cash and U.S. bonds on hand, and you felt like, hey, that's the beautiful thing about being a totalitarian / capitalist state, that you can always basically buy your way out of it.
Right.
What's the position now of China as, when you look at their stockpile of cash and bonds, what could they do to get out of it? Could they?
They would. Well, they own enough foreign assets now that they could lean on Europe, the United States, Australia, other parts of Greater Asia to really help them get out. It would be in everybody's best interest for China not to go through the crisis we had in 2008, where in 2008 you could make the case that our crisis supercharged their economy, where China was growing at a exponential rate going into the 2000s. They became the safe haven in 2009. and it really supercharged their economy. So we won't have that ability where if China's bubble bursts, that will, force everybody to come to the United States. People will quickly, that may happen in the first month, right? Until it sets in that, wow, 30% of this American company is owned by a China firm. And I found that in the politics that I've gotten into, in running for Congress, I go to speak to some of these companies and they're great. Let's come in. We'd like to give you a tour. And a couple of days later, you hear from their PR person, "Hey, you're the China guy, right?" And I'm like, "No, I'm Dan, and I'm running for Congress. I don't know, I'm the China guy." "Yeah, no, you're the China guy. We're going to reschedule." So I look at that company and I find they had 59 subsidiaries in China.
Okay, we'll get back and wrap up our interview with Dan David and Jed Rothstein in just a minute. You are listening to Jill on Money. How about you hop on to JillOnMoney.com and check out all the good stuff we've done in the last few weeks. Sign up for the newsletter while you're there. It's free. Okay, we'll be right back. You're back with Jill on Money to close out our interview with filmmaker Jed Rothstein and his favorite character, Dan David, of the China Hustle. We've got a big question to wrap it up. Here we go. China is a huge, freaky, scary unknown.
Yeah.
Give me another.
Well, totalitarian governments that are controlling our media. I mean, China and Russia and other governments don't allow us to control their media and their internet companies. Like, you can't, by law, control an internet company in China because that's considered media. But they're set up in Silicon Valley right now. They're trying to buy our media companies to control our narratives, to make sure that Democrats hate Republicans and Republicans hate Democrats. We focus on hating each other, and we don't really notice that it's outside influences that are keeping us busy with all of this nonsense.
So, Jed, when you hear, did making this movie completely freak you out? I mean, let me just say that you made a movie about Al-Qaeda terrorists. How does this compare?
Well, this is systemically scary because of everything that Dan was just talking about. I'm a little more optimistic when I see guys like Kun, one of the researchers who went to jail, whose story is in the film, because I think there are a lot of people in China who want to make it a sort of good global citizen and good financial market citizen. And
let's see what happens now that President Xi is Emperor Xi.
They have
forever.
Yeah, that's hopefully anybody in our country would say that having a leader for life is generally a terrible thing. And I don't want to soft pedal the danger or the problems, but I do think there are a lot of people who want to shed light on things and make China the best place it can be, which is important for us, because at the end of the day, we are becoming more integrated, and we have to. And I think whether or not we desire it, we're going to all be part of this big global market and this big global village. And I'd rather have it be more open, like America, than closed, like these places where there's no free speech and the president can be on for life. I try to look at the half full side of it and see these guys who are risking a lot for a better future.
Okay, that's it. That's the program. Thank you so much for listening. It has been fantastic. Thanks to Jed Rothstein. He's a filmmaker. And Dan David, the character in The China Hustle. Go check out this movie. Go see it in the theater. Go buy it at home and pay heed to it. Thanks to you for listening. If you've got a financial question, shoot us an email. Ask Jill at JillOnMoney.com. We'll see you next week.